everybody, I'm Mike DeSepoli. Welcome back to the Ask the Advisor show, brought to you by Heritage Financial Advisory Group. Today we're going to take stock of the market's big recent rally off the March 23rd low. After seeing the market fall a long way in a short period of time to hit that March 23rd low, we've seen a very strong and powerful rally up about 40+% from the low at this point, and we're getting a lot of questions from people that want to know what's driving the action, what are some of the things that we're looking at, and of course, can this action continue as we move ahead? So there's a lot of things we think driving the markets, but today we're going to talk about 6 of the main drivers that we see. Some are obvious, some not so obvious, but I think they're important, and we want to discuss those with you here today. So the first and foremost is something that should take nobody by surprise, is this problem, this coronavirus pandemic, has seen unprecedented monetary support from the federal government, with the Federal Reserve injecting trillions of dollars into the markets and to shore up the different banks as part of the financial system to make sure that when individual companies and corporations go to their bank to get funding that they desperately need, the banks have enough capital on hand and they're not finding themselves in a scenario where they have to pull back on all these lines of credit, leaving business owners without the capital they need in a tough time. So that's the first and most important thing. It's a very obvious one. A lot of people talk about the Fed and all the different operations that they're rolling out right now, but they've done a lot. The response from them has been swift and it's been strong, and there is no change in the future path of their support right now. We think we're going to see low interest rates all the way out into 2022 and beyond. So number one, that's not going anywhere for quite some time. The second and most important point that we see is that the economic data has come in a lot better than feared. Okay, it hasn't been great economic data, but it has been better than the expectations. And if you've been following along with us, we spoke about this a few videos back. The market really doesn't deal in terms of good or bad. It's just better or worse. And we're seeing things that are coming in better than expected. If you think back to March, a lot of the videos we were putting out at that point, we were saying that we felt that the economic data and the markets were overshooting to the downside, really just assuming too much carnage and economic damage. And now we're starting to see some of these green shoots in the economic data, and the market is responding accordingly. Third thing is, we think, and we still see this, there is excessive bearishness or negativity around the stock market in the investment community. And while that might sound like a bad thing, it's actually a very good thing, because markets tend to be very contrarian in their views. So when everybody is bullish, when everybody is positive, a lot of times that will mark what we call a market top, a plateau, a high point. When everybody is bearish or negative, those usually mark very good times or very good buying opportunities. And that's what we saw back towards the end of March. We saw excessive levels of bearishness in the market, which indicated to us that this was probably a good idea to deploy some capital and do some selective buying. But these levels of bearishness still remain elevated at this point, and for us that's good, because it usually provides tailwinds to the markets, because again, the herd is usually wrong. So if the herd thinks we're going lower, there's a very good chance the market can continue its climb. Number 4, we are seeing record amounts of uninvested cash. Okay, there was a statistic put out the other day by, I believe, Fidelity. I'll double check on who put it out, but 30% of all adult investors sold their entire portfolios in March, their entire portfolio. So aside from the problems that creates and the losses that they probably committed themselves to, now you have a lot of investors on the sideline, and nobody wants to hear about the party they're not invited to. This money needs to go somewhere. If you've been working with banks for quite some time, you know what the interest rate environment has done to those banks. You're getting little to no yield on your money. And of course, money needs to go somewhere to earn return, and we think we're going to see a lot of this money come back into the stock market. It's estimated there's about $5 trillion right now on the sidelines in money markets, and this is a very important point. I want to spend a little extra time on this one. When the market was falling in March, and it was falling day after day, 1, 2, 3,000 points at a clip, and people said, how can this persist? What you saw was peak levels of fear and people just reaching for their money. Anything that could possibly be sold was put up on an auction block, and that's why having a plan and being patient has rewarded investors who rode through it and have come out on the other side looking better than before. So again, record amounts of money left the market in March. Record amounts of cash still sit on the sidelines of this market, and at some point we're going to see this money come back. It's already starting to happen, and this could be a tailwind for the markets to help them continue their climb. Number 5, fears of a second lockdown have drastically subsided at this point. Okay, initially when we had the first lockdown, we started to reemerge from it. The market was continually pricing in the possibility that there could be a second wave and a second lockdown. And while there still could potentially be a second wave, a lot of the government, what the government has told us, from the Treasury Secretary to President Trump, is that they understand the magnitude of damage that was caused economically by the first lockdown, and it's just not sustainable for us to go into a second lockdown. So again, health is important. We want to make sure cases and hospitalizations are not getting away from us here. But the fact that the likelihood of a second lockdown has been taken off the table is something, again, that the market sees as a positive. And the last one, and this is, again, something that's not spoken about much in financial news media, large institutions of the financial sector have missed large parts, if not most, of this rally. Okay, many firms, all right, a lot of this information is public. You can see they took a very bearish stance back in March. Obviously, early on, that looked like the right thing to do, but the market has since run away from a lot of these firms. And these firms have two choices to make. They can continue to be bearish and they can sit on the sidelines, or they're going to have to try to participate in this rally. And again, number 4 and number 6, very similar to each other. When you have a lot of money outside of this market, outside of this rally, and it starts to try to make its way in, it will help the market continue to climb higher. So again, these are 6 things that I think are very important for investors to be keeping an eye on. This is what we think is powering the backdrop of this rally. Now, going forward, of course, there's risk around coronavirus. So we want to make sure cases and hospitalizations are staying down and we don't see ourselves in a scenario similar to what we saw late February and early March. So we thank you for tuning in. If you have any questions about any of these items or other things you want to discuss, please reach out to us. Always happy to talk to you about the things that matter with your money. Have a great day, and we will see you back next week on the Ask the Advisor Show.